This is how a family trust can benefit business owners and save you a lot of money. Hi, I'm Dave. I help make Canadian business owners' goals a reality with innovative financial advice. A trust is a legal arrangement used to transfer the management and control of assets from one party to another. The trust is created through a trust agreement or a trust deed, which outlines the terms and conditions of the trust. There are three key parties involved in a trust agreement: a trustor or settlor, a trustee, and a beneficiary. The trustor is the person who creates the trust. They can transfer assets, including money, property, investments, or other valuable assets to the trustee. The trustee then manages and administers the assets according to the instructions provided in the trust agreement. The trustee has a fiduciary duty to act in the best interest of the beneficiary and to carry out the wishes of the trustor. The beneficiary is the individual or group who will receive the distributions from the trust, which can include income generated by the trust's assets, specific gifts, or other forms of support outlined in the trust agreement. Trusts are commonly used for various purposes, such as estate planning, asset protection, charitable giving, and managing assets on behalf of minors or individuals who are unable to manage their own affairs. They offer flexibility, privacy, and potential tax benefits depending on the jurisdiction and circumstances. There are many kinds of trusts, each serving a different purpose. The two main types of trusts are living trusts and testamentary trusts. A living trust is created and effective when the trustor is still alive. It's primarily used to manage and transfer assets to beneficiaries during the trustor's lifetime while avoiding probate. A living trust can be revocable or irrevocable. When a living trust is revocable, the trustor can alter the trust. When it's irrevocable, the trust cannot be modified. A testamentary trust is created through a will and becomes effective upon the trustor's death. It allows for the distribution of assets to the beneficiaries according to specific instructions outlined in the will. Testamentary trusts are often irrevocable. The focus of this video will be on a type of living trust known as family trusts and how they benefit business owners. A family trust, also known as a family business trust or a family investment trust, is established by a family to hold and manage the family's business interests. It allows for the seamless transfer of ownership and control of the operating company from one generation to the next. Family trusts often have provisions for the distribution of profits and management responsibilities among family members. A family trust can be set up at the same time the business is started, or it can be woven into the corporate structure later. If a family trust is added after the company has been operating, there could be tax implications and added costs to alter the corporate structure. It may not be obvious from the onset of a business if you'll benefit from a family trust, so the decision can't always be made from the get-go. To set up a family trust, you'll need to consult with a lawyer and an accountant with experience dealing with family trusts. Here are 4 ways a family trust can be beneficial for business owners. Number 1, succession planning. If you intend to pass down the ownership and control of your business to the future generation, a family trust can be a valuable tool. It helps to ensure a smooth transition, protects the interests of family members, and provides a framework for the management and distribution of the business assets. Number 2, asset protection. Family trusts can offer asset protection benefits by separating personal and business assets. It can help shield the business from potential risks, creditors, or legal claims, adding a layer of security for your business assets. Number 3, estate planning. If you have significant assets tied to your business, a family trust can be part of your comprehensive estate plan. It can help minimize estate taxes, facilitate the distribution of assets, and provide financial security to your family members. Number 4, selling your business. Having a family trust set up can offer major tax benefits when selling your business. To illustrate, here's an example of a family we recently worked with. Kate and John own a clothing company valued at $12 million, and they plan to sell it in 3 to 5 years. They each had a 50% ownership of their company. If John and Kate sold their company for $12 million under this corporate structure, they would each be eligible to use their lifetime capital gains exemption, saving them approximately $1 million each in taxable income. meaning they would still have to pay tax on $10 million. We recommended that they restructure their corporate setup and have the family trust own 100% of the business shares, with themselves and their 3 children as beneficiaries of the trust. Lastly, we advised they create a holding company and have that as an additional beneficiary of the trust. The new corporate structure will help John and Kate accomplish several things. The family trust will allow them to now have 5 lifetime capital gains exemptions as opposed to 2, which will decrease their taxable income when selling the business by approximately an additional $3 million. Having a holding company as a beneficiary of the trust will allow them to funnel any pre-sale profits through the trust and invest it outside of the operating company, which helps protect the assets from creditors, creates a more seamless sale in the future, and helps grow John and Kate's wealth. Thank you for watching. Are you ready to achieve your goals with a customized financial plan? Take the first step by booking a call with the link in the description below.